Morning, everyone. We're just going to wait one more minute. Oh, it's now 10 o'clock. Let's get started. So thank you all for joining me this morning. We're going to discuss ARMS, and ARMS means adjustable rate mortgage. So you probably have heard, really over the last, oh gosh, honestly, 10, maybe even 15 years, I could comfortably say ARMS or adjustable rate mortgages have not been a great option. And a lot of it has been because the yield spread on the mortgage rates and the T-bills has not been very different. And so without a big yield spread, adjustable rate mortgage, you might get an advantage of 1/8 of a point, or you lock it in, right? So you go with a fixed rate. That's really changed over the course of the last 6 months, 9 months, where we have seen now the adjustable rate mortgage having a huge and significant advantage for clients. So we're going to make this really interactive. Please feel free to put any questions in the chat box, and I'll do my best to stay on top of it and watch you can do it either the chat box or in the question and answer section, and I will do my best to answer all of the questions. But today I just wanted to introduce the adjustable rate mortgage, kind of remind you what the advantages are of the adjustable rate mortgage and why it can be a great fit for our clients now. I have two that are closing with adjustable rates mortgage because of the advantage. So why ARMS are back is, you wind the clock back 10 years ago, and everything was based on the LIBOR, right? So it was not based on the T-bill. It was always based on the LIBOR. Now we're on a different index. It's called the SOFI, SOFI index. And with the changes in the market, we've now seen this yield spread change and to our advantage. So that, for example, today we're closing on an adjustable rate mortgage for a purchase at 5.875. Huge advantage for that buyer. Their plan is to pay that loan off, right? They're going to pay that loan off within it's a 10-year fixed. They're going to pay that loan off in 10 years anyways. Why not take advantage of that? So that's why you're seeing a resurgence of the adjustable rate mortgages back in the market, is because of the low rates. When offering an adjustable rate mortgage, this gives your client a strategic advantage, right? Especially if you've got somebody who says, hey, look, I just need this loan for 3, 5, I'm going to pay it off in 10 years. The loan is still amortized over the full 30 years. So it's not like they're put into a 10-year fixed. It's fixed, that rate is fixed for 10 years, let's say, or 7 or 5, and it's amortized over 30 years. So they get the advantage of the lower payment with that. Why I keep referring to the 10-year is, believe it or not, the 10-year rate has been better than the 7-year adjustable rate. So the way these ARMS work and why they give them a strategic advantage is, now I know as a buyer, hey, I'm locked in for 10 years at this 5.875 that we're closing today. Why would I not take advantage of that? More than likely, there'll be a cycle in that 10 years that either the interest rates drop again and I will refinance, I'll have paid off the mortgage, or we've now seen the trend of people staying in their homes on average 10 to 12 years. So it gives them a big advantage. But what happens at the end of 10 years? That's a common question. At the end of 10 years, I'm using the 10 years as an example, or 5 or 7, but during that time frame that it's fixed, then it would adjust. And the one that my client's in right now, it could potentially adjust by a point every 6 months. So that gives him an understanding that after 10 years, he would have an adjustment, and it would be maximum 1 point. So maximum, he would go from 5.875 to 6.875 to kind of give you an idea, and that could adjust up and down every 6 months. The rates on those don't move that drastically. So I'd be surprised if he would see a point. But could it happen? Yes. And we always have to have that conversation with them. Anytime anybody's looking at using an adjustable rate ARM, we do provide them with multiple disclosures. All lenders have to provide disclosures, and there's one form that's called the CHARM document, and you can access that online. All you do is type in CHARM, and it's basically a disclosure about adjustable rate mortgages. So something to consider when you're looking at the adjustable rate mortgages. Secondly, who is the ideal borrower for an adjustable rate mortgage. We want to look at at the totality of that buyer. Is it somebody that's a first-time home buyer that might have some trepidation about having, gosh, I'm not sure how long I'm going to be in this house. I'm not comfortable with it being adjustable after 5, 7, 10 years. That makes me nervous. Well, then obviously we don't want to put that borrower in that situation. If they're doing a government loan, yeah, this is not going to probably be the best option for them. This would be more of a conventional adjustable rate mortgage. A lot of times what I see is it's borrowers who know for sure, hey, I know I'm only going to be in this home for X period of time, or again, I'm going to be paying it off in less than that period. So this is a perfect option for them. So finding out, you really want to ask them when you're talking to your clients, what's their temperature on doing an adjustable rate mortgage? If they feel comfortable with that time frame, then this is something definitely worth having a conversation with them. Here's the key. Whether you think they are ready for it or not, it's important to introduce the program to them so that you look to them, show them that you have, or the lender should be having the conversation, that we have their best interest in mind, right? That we're offering them a product that they may not be aware of. And sometimes they'll say, hey, thanks for educating me on that, but I'd rather go this direction. Absolutely. But at least we offered that to them and went through what that tool would look like for them in case they did want to take advantage of an adjustable rate mortgage. Again, may not always be a great fit for a first-time home buyer, but for a client that maybe this is their second home that they've bought, I've got one where he's going to refinance into an adjustable rate mortgage. We'll drop him from 7.25 when he bought the property a couple of years ago down to the 5.875. So once we drop his rate down, he's gonna save several $100s a month. That's a great win for him. And again, he's looking at the 10-year fixed because he knows that he'll either have it paid off in the 10 years or his plan was to move back east. So again, who the ideal ARM client is really depends on their appetite, I would say also their comfort level, knowing that at 10 years, let's say if we're using the 10-year, at 10 years, I'm going to have to make a change and I'm going to have to lock in. I'm going to have to refinance, or am I going to be selling the house? What am I going to do at that 10-year? And am I comfortable with the adjustments? So I mentioned that we provide disclosures. We have a thorough conversation with the client, go over exactly what the payment structure looks like. There's also a nice option for somebody who wants to buy into an adjustable rate mortgage. They can do a temporary buy down on the rate, or permanent, but they can do a temporary buy down. So you know how we talk about 3-2-1 buy downs where the seller is contributing towards closing costs. I can now take those funds and use those same funds to do a temporary buy down on an adjustable rate mortgage. So now we're really talking where we could get somebody into the fours. When you're looking at competing with new home builds, or a client who says, hey, I need to be in this particular area where there isn't that option to buy in a new home subdivision, this again can be a great option for them to have at their disposal so that they could do the buy down and get that really low introductory rate to get them into the home. Now we still have to, with the buy down, I still have to qualify them at the higher rate. Let's say 5.875. Still have to qualify them at that rate. But again, if I've got somebody who is, let's say they know that they're going to be getting a pay raise, hey, this might be a really great option for them to take advantage of either the adjustable rate mortgage or the buy down option to help them get into the home. That way too, they are able to buy more home potentially, right? So if I've got somebody that's like a situation where I have two buyers, let's say, and one doesn't show as much income as the other person, this might be another way to go where I could say, hey, we're going to put you in an adjustable rate mortgage because you've got the disposable income to use. Then they can always take the additional money that they would have paid. Let's say if they would have done a fixed at 6.25, right? They could take that additional funds and put it towards principal with a conventional loan, there's no prepayment penalties, right? So they could still pay down the mortgage if they wanted to. They'd still have that flexibility. Again, they could pay it off at any time because again, there's not a prepayment penalty. So there's a lot of great options with adjustable rate mortgages. So let me take a look here and see, anybody have any questions? I know I've covered a lot of information, I know in just kind of a short period of time. And excuse me, let me look, no questions. Okay. Um, with adjustable rate mortgages, let me close that up. With adjustable rate mortgages, and thank you both for attending. With adjustable rate mortgages, if you are the real estate agent, a lot of my clients, they'll say, gosh, Stacy, I don't really want to talk about rates. I don't want to talk about programs. Will you make sure and cover this item with them? And absolutely. So one of the things you want to do as a real estate agent is make sure that your loan officer is educated on the adjustable rate mortgages and is able to offer those. You have to be able to articulate an adjustable rate mortgage and just exactly what you can offer the client, right? So I always say not all lenders are created equal. And there'll be lenders who are going to try to push clients into an adjustable rate mortgage who may not feel comfortable with that. Just make sure you're having that conversation with them that, hey, you want to make sure you completely understand everything that there is about the adjustable rate mortgage and the term that's fixed, what the adjustments look like, so that they go into it with complete understanding of what they're dealing with. I'll have some people who say, yeah, gosh, 20 years ago, 30 years ago, I got burned on an adjustable rate mortgage. I actually got into the mortgage industry in the early 90s. And adjustable rate mortgages were very popular back in the early 90s because interest rates on a fixed were still, believe it or not, like 10, 13. And so when rates dropped, a lot of people that were in adjustable rate mortgages in the 80s then jumped to a fixed rate because rates had dropped so much. So you can kind of sense that, if we can get them into a 10-year, that's even better because back in the 80s and early 90s, a lot of folks were taking 3 and 5-year fixed rates or adjustable rate mortgages, there's nothing wrong with that, but 3 years goes by quickly. 5 years goes by quickly. And some of those loans had varying adjustments. And that's where a lot of people felt like, hey, I really got burned on an adjustable rate mortgage. So I always tell people, this is not your grandmother's or your mother's adjustable rate mortgage anymore. This adjustable rate mortgage is structured differently, right? Which is kind of an anomaly right now that the 10-year, believe it or not, is priced better than the 7-year. And we'll take it. I am not complaining. I'll take that 10-year fixed at 5.875 all day long because it really gives my clients more buying power. And again, if they plan on paying it off, which in both the cases that I've got right now, that's the situation. Why not take advantage of that lower rate? And you've got the fixed in place adjustments so that you're not dealing with random adjustments. Any questions at all? I know I covered a lot of material. I thought we'd have probably some more questions from everybody, which it's totally fine. It's totally fine. I can kind of share with you a little bit about the market too while we have a few minutes. We obviously Fed drops the rates last week. We didn't see much on the mortgage side. A lot of people ask me, well, wait a minute, if the Fed drops interest rates, why don't we see that immediately on the mortgage side? Well, unfortunately, on the mortgage side, the mortgages they're tracking on the mortgage-backed securities. They're not tracking identical to the T-bill. So yes, is there a correlation? For sure. But in some cases, typically 3 to 5 days before the Fed announces any kind of a rate drop, that's when we see the rates improvement. Day of, then now becomes very dependent on what the bond market and the stock market, how they're reacting. Typically, when we're seeing better interest rates, is really driven by, I hate to say it, but bad news. I always said the bond market loves bad news. So if there's bad news, that means people are leaving the stock market, they're coming towards bonds. Our bond rates then on the mortgage-backed securities get better. So that is really important. The difference is with the adjustable rate mortgages, they are not tied to any kind of a T-bill or mortgage-backed security driven in that respect. They're on a completely different index and fund margins. So you're not going to see, hey, I saw the rates drop quite a bit with the Fed. What happened to the ARM rate? That necessarily does not correlate directly with what the Fed does. Hopefully this was helpful. Oh, we got a question. Okay, so the question is, not regarding the ARMs, but with a 3-2-1 buy down, how does that work? Is there a set price on buy down to buy down an interest rate, or does it always change? That's a great question. Thank you, Andrea. Okay, so with a 3-2-1 buy down, only the seller or the real estate agent can participate in the buy down. Your buyer cannot do their own buy down. And honestly, it doesn't make sense for them to do their own buy down. If they're going to put money towards a buy down, it would be better to do a permanent buy down on the rate or have them put more money down on the principal. So always remember when you're asking the seller for funds, you want to know in advance, and I have like a spreadsheet that I use to calculate what they would need for seller concessions to do a buy down. So that's you would put it in your purchase contract, asking for the seller concessions. Typically, for a 3-2-1 buy down, you're going to need a minimum of 2% seller concessions, potentially even 3%, but for sure you're going to need 2%. Most of the time I see between 2 to 2.5 to buy a rate buy down, a temporary buy down. So asking it from the seller, and then hopefully the seller agrees to it, and we know once that comes in based on the conversation with the borrower that that's what they want to do. They want to do the temporary, either the 3-2-1 or a 2-1 buy down. 2-1s are also pretty popular. So there's actually a couple of other things that are important with this. Once we take in those funds, and let's say rates drop next year, and the borrower says, Stacy, I want to refinance right away because rates are lower than where I'm at right now. The monies that were taken from the seller are set up in an escrow account that the lender, we hold on the side to put towards the additional payment to cover the gap between the note rate, which is your permanent rate, right, before the buy down. We would make that payment then from that escrowed account from what the seller contributed. If my buyer does a refinance prior to running out of those funds in the escrow account, I can take those funds, use them for closing costs, or apply towards principal. It is super cool. It's super cool. It's a really great option. The main thing for us as a lender is to watch the rates, make sure we're watching that escrow account so the buyer know that the buyer can, when it's an opportune time for them to refinance. We're doing a lot of refinances right now on these 3-2-1 buy downs and 2-1 buy downs from when people were buying in the 7s. Now is a perfect time for them to refinance. So is there a set price on buying down an interest rate? No, there is not a set price. Rates change on a daily basis. The cost of the rates change. So what I recommend is when you're getting ready to write that purchase contract, call me, call your lender, right? You're going to call your lender. You're going to ask them, hey, to do a rate buy down today, what does that look like? How much do we need in seller concessions to buy down the rate? So then I run the calculations and I can say, here's exactly either the dollar amount that you're going to need or the percentage. My calculator tells me both, and I can tell you exactly how much then to write into the purchase contract. Typically what I see when we're doing any kind of a rate buy down is, and it depends on what the, what the purchase price is, the down payment. There's a lot of things that go into the calculation, but typically we see a full interest rate, 1 point in interest rate. So if I'm at 6 and let's say a quarter, I could be down to 5 1/4, on the rate. So there's a huge advantage to doing those 3-2-1 buy downs. Because again, now I'm all of a sudden giving that client a much lower rate. Does it always change? Yeah, so if you write that purchase contract today, we're going to be very close. I always kind of give a little pad to it just to be on the safe side. Can the market change? Yes, and we've had crazy things happen. But if that purchase contract doesn't go through and you've got another one that, hey, we're writing a new purchase contract, make sure you reach out to your lender, have them rerun the numbers just to make sure again, because we're going to use it based on the purchase price and down payment. So if your purchase price changes or your down payment changes, that changes the calculations sometimes significantly. So it's important to make sure you're communicating with the lender in regards to exactly what the purchase price and down payment is, if that's going to change. I hope that was helpful. All right. Anybody else have any other questions? So that concept that we were just talking about, that can apply also to adjustable rate mortgages. So you can use that same buy down concept with an adjustable rate mortgage, which gives, again, can you imagine doing a 3-2-1 buy down where our first rate is at 5.875? Now I'm at, say, 3.875 with 4, you know what I mean? Just doing a 2-1 buy down. I could get somebody into a home with that initial 3 years being even lower to give them an additional advantage. So I've always been one where I'm very cautious with adjustable rate mortgages, and I always try to educate people on them. But what I'm seeing now in the last 6 months with adjustable rate mortgages, it's only getting better and giving people an additional advantage. As a real estate agent, my approach would be to introduce it to them and ask them, hey, talk to the lender about, is this a good option for you? Another question is, let's say a client does a 10-year ARM, and once they get to the 11th year, they refinance. Would that restart the loan to a 30-year? That's a great question. Thank you, Andrea. Okay, so it depends on how they structure it. So one of the things is, if somebody comes to me and says, hey, Stacy, I want a 28-year mortgage. I want a 28.5-year mortgage. We can easily do that. All we do is we set up on the amortization of that loan at the specific timeline that the client wants that loan to be amortized over. We can do this on purchase. We can do this on refinance. So in this situation, I'm at year 11. Yeah, I don't want to go back to year 30 and have to start all over again, paying interest on the upfront side. I can now set that loan at, let's say, a 20-year amortization, 20-year rate, 20-year amortization, and get them an even better interest rate at 20-year versus 30, and they're not rewinding the clock back to 30. That's a great question. Thank you for bringing that up, Andrea. That's a great question because, yeah, and just know that that's an option for any of your clients when it comes to a refinance or a purchase, that they can determine what the amortization on a loan can be. I did one a few years ago for 12 years. They were doing a 15-year. We did a refinance because I don't want to give up the 3 years I've already put into this. Absolutely, we can do a 12. Hopefully that was helpful. Any other questions at all? Well, we're almost at the bottom of our half hour. I'll put in the chat my contact information, and so that, let's see here. Sorry, I'm not sure if you can see the chat for me. So I'll just tell you, if you need to contact me, my name is Stacy Gross. I'm with Nations Lending. I've been in the mortgage and real estate industry for over 30 years, and been with Nations Lending for 3.5 years now. So it's a great company. We have a full array of product. We work also with additional lenders, but we're direct to Fannie and Freddie and all of our jumbo loans. We've also got access, like I said, to these adjustable rate mortgages. It's really been a great opportunity for me to be at Nations Lending. I am a producing branch manager for Nations. My cell phone number is 602-418-2833. Again, 602-418-2833. And my email is my first name, Stacey, Stacey, .gross@nationslending.com. Feel free to send me any follow-up questions, or if you think of something after this call and you go, gosh, I wish I would have asked about this, don't hesitate. Reach out and let me know if you have any questions. Happy to provide you or your clients with additional information about the adjustable rate mortgage. This is right now, in my opinion, one of the best kept secrets in the industry. And I think the people that, I don't think, I know the people who wrap their arms around this and use this as a tool to help their clients are going to get a lot of positive feedback on this because, again, you're bringing something out to them that hasn't been talked about in a really long time. And it's opening up opportunities for people to get into homes with a much lower interest rate. How exciting is it to be able to say, hey, you qualify for a 5.875 interest rate? That's pretty exciting. And on a 10-year fixed, makes me even happier. All right. Well, thank you everyone for your time today. And if you have questions, again, feel free to reach out. I am happy to help in any way I can. Have a nice day.